I wouldn't describe myself as bullish on the housing market, but I think I'm a realist. I think I can see that prices are going to continue to go up, generally speaking. And as you say, people that say I'm not going to buy because prices are too expensive, in 5 or 10 years, they're going to be buying probably, but they're going to be buying at much higher prices than they are today.
Today we're joined by Cameron Kusher. G'day, welcome onto the show. Cameron, how you doing?
I'm good, thanks, Aaron. Thanks for having me.
What is it going to take to slow down house price growth? Or is this the horses bolted and we now live with this?
Look, I think to some extent the horse has bolted and we now live with high property prices, but I don't personally think that prices are going to rise as rapidly as they have in the past.
As you kind of pop the hood on that question, which is supply and demand, what's your analysis? What's your data showing up?
I do expect we're going to start to see, as interest rates come down, more new housing coming out of the ground because it'll actually stack up and there'll be the buyers for that property.
What do you need to know to make an educated decision to pull the trigger?
I think the thing you need to know is it's good to look at the data, but it's also good to think about what your intention is and what you're buying that property for.
G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm always looking for the biggest, brightest minds in property, real estate, and today we're joined by Cameron Kusher. G'day, welcome onto the show. Cameron, how you doing?
I'm good, thanks, Aaron. Thanks for having me.
Nah, mate, I've seen you speak at plenty of conferences. You kind of just sprout numbers off the top of your head like you saw it in there, like some amazing wiki memory that you have, buddy. We're going to go deep on everything you know about the property market. Because you sit on a mountain of knowledge. You've got an extensive amount of experience. For those that aren't familiar with Cameron Kusher, I'm talking about your economic research that you had with RBA Group, with CoreLogic. So people might know that as RP data, for example. And I'd love to just go through your experience and what kind of led you to this point when you go deep on the economics that happen in the Australian property market.
Yeah, good question. I was a weird little kid. I used to read the Guinness Book of Records and regurgitating facts. I used to collect footy cards and I'd sit there
and remember all their stats.
Yeah, remember all their stats as well. Funny thing was I was never that great at maths though. So, but I was always interested in statistics. So I grew up, I always was interested in property, and I think that came about because my parents were forever renovating their house. And I remember being a young kid and saying to them, I just want to own a house that doesn't need work because we were always moving bricks on the weekend or, the house was never finished.
Yes.
So I think that really got me interested in property. My first job in property was working on the weekend at the local Harcourt's real estate agent, taking the rent when people used to walk in and pay the rent and doing RP data searches. Yeah. So I ended up going to university and studying property economics. I thought I wanted to be a property developer, and my first job out of university was for a property developer, but they weren't a great property developer and they ended up going out of business. And I was like, I don't know that this is quite what I'm looking for. Yeah. I kind of just came across this job working for PRD Nationwide it was a research manager role and looking at statistics and writing reports about what's going on. And I got that job and I've been doing the same sort of job ever since. So, and, I'm really passionate about taking difficult to understand concepts about the economy and about the property market, whether it be metrics that people don't really understand or what they really mean, and explaining them in very simple terms. And I think that's something that not a lot of people do. If you go and speak to someone that's a pure economist, they tend to talk at a very high level and use a lot of jargon and don't really make it very easy for people to understand what they're talking about. Yeah. I'm quite passionate about communicating what's happening, but in easy to understand terms for anyone.
Lovely. Thanks very much. I guess we're really entering this stage, this phase in property where you get, perhaps a lot of buyers agents they're very data driven. Yeah. There's a lot of data scientists in this space as well. So there's no shortage on data. Yeah. There's no shortage on the property market being analyzed to the nth degree as well. But I guess where I've seen your work become, one, prolific, but two, very relatable is you can translate that, like you said, into a common language where you don't have to be reading the AFR inside out to then understand what are the acronyms or what are the trends that are starting to emerge as well.
Yeah.
Cool. I guess, what's that saying? Make trend your friend, isn't it? And I guess if you look back on your career, do you see kind of where we're at right here, right now, as a cycle, as a market cycle? Do you see this as an anomaly that we're in, for example, as well, where when I give it some context, particularly around housing affordability, because if you pull up articles from the 1960s, housing affordability was still an issue then. Is it just a little bit more profound today, or do you just go it's relative to where we've been in previous cycles?
Look, I don't think it's necessarily relative to where we've been in recent cycles or previous cycles. Housing affordability has always been a challenge. Property is the biggest investment most people will ever make in their life.
Yeah.
So, most people have to take on debt to enter into the housing market. It's just the fact that over the last few decades, we've seen property prices rise so much more than incomes. And we've seen more and more households become dual income households. So, when I was growing up, my mother didn't work.
Same.
My father worked full time, and they could support a family of three kids on one wage. It's pretty hard to do that these days. Most people are now at least one of the parents is working full time, and the other one is working at least part time.
Yeah,
childcare costs are very expensive. A lot of people are sending their kids to private schools, so there's all these additional expenses. I do feel like affordability is stretched, but I would also say I don't think that we're in place for an imminent major decline in property prices. And if you look at the fundamentals that are driving things, we've still got a very strong growing population.
Yeah.
That does fuel demand for more housing. Interest rates are on their way down. That means people are going to be able to borrow more. And there's a lot of people that don't own a home that want to get into a home. And we're also seeing that rents have increased quite a lot as well. So people that are renting, it's not just about mortgage stress, it's also about rental stress. And I think a lot of people are maybe not having the best experience in the rental market as well, because the landlords have put up rent quite a lot, or they're living in buildings that are not really that great, or they're having to go into share housing. So that's the situation in the rental market is going to drive more people to want to own their own home as well. I think increasingly though, the challenge is people can't afford to live in the areas that they want to live, and that's because houses that are in those markets are fairly tightly held. And in a lot of the more desirable areas of the cities, we're not delivering alternative housing, whether that's townhouses or apartment buildings. So people that want to live in that market but can't afford a house have the opportunity to move into those areas.
Yeah. That's an interesting point, which is I want to live in this particular area, but I can't get in. Isn't that responsibility of the borrower, like the client and the buyer, as opposed to, that's not a widespread problem. That's a check your ego problem.
It's definitely an expectation problem.
Yeah.
I guess the counter to that is, look, in Sydney, we know that the eastern suburbs are probably the most desirable part of Sydney. There's beaches, it's got all the amenity.
Yeah.
But all of the new housing goes into the western suburbs of the inner west. So we're not building higher density there. So I think yes, you need to reset your expectations, but I also think it's reasonable that we don't just have these exclusive enclaves that are for people that can pay, $5, 10, $15 million for a house, and we don't have those options for cheaper housing in those areas. But to be realistic, I think anything that was higher density that's going to be built in the eastern suburbs is still going to be very expensive. So for a lot of people,
and if you can actually get higher density pushed through would be another challenge as well.
Exactly. So I think for a lot of people, like, eastern suburbs is just not a realistic prospect. It's not attainable, certainly not if you're buying your first or your second property. If you end up getting a really great job or you start your own company that gets very successful, then maybe you can move into that area.
They're exceptions to the rule.
They're very much.
You talk about maybe a windfall out of inheritance, like you said. You saw your business, for example. At that point, you've got much different challenges, good challenges in that sense, but. Yeah, I think for the common person trying to break through that barrier, call it a suburb barrier, for example, I call it a glass ceiling, perhaps. To break through takes something exceptional.
It does.
And you are the exception to the rule. The rule is, hey, look, if you can't buy in that area, you just simply don't afford. Or the alternative is you rentvest.
Yes.
Which has its own complications. And we're doing, my team and I are doing a massive deep dive into rentvesting at the moment. And you could argue both sides of the coin on that.
Yes.
And there's no right or wrong, but ultimately it comes down to, you and I speaking, we've got kids. So then it's a whole myriad of challenges around kids, stability, security, schooling.
Yeah, once they're in school, you don't want to move them out of school. And if you are renting and investing, you don't have that security of tenancy that you have when you own your own home.
Correct.
And I think also with a lot of rent vesting, a lot of it's predicated on property prices continuing to grow in the future like they have in the past. And obviously, as prices get higher, it's harder to see that same level of growth in property prices as we've seen previously.
So I guess if you crystal ball this a little bit as well, I'm not going to hold you to this, but you said, hey, look, past performance
isn't an indicator of the future. Yes.
You take that, but you go, hey, man, what's going to slow down this Australian property market? Because you cited before rates will come down.
Yeah.
We had 13 rate rises and it still didn't stop house price growth as well. So, I mean, for more recently, take people, I've been in the game 10 years and banking before that as well. So in my past, I've been through a GFC. Yeah, you've gone through the Royal Commission, interest only caps, for example. Then we had COVID, you had 13 rate rises, and still the property market is resilient as ever. And then now we're looking forward and we're like, hey, rates are dropping. Immigration, migration's still strong, for example. So what is it going to take to slow down house price growth? Or is this the horses bolted and we now live with this?
Look, I think to some extent the horses bolted and we now live with high property prices. But I don't personally think that prices are going to rise as rapidly as they have in the past. And there's a couple of reasons for that. Now, some areas will, but I think as a whole, we're unlikely to see prices rise as quickly. The first one is you go back to the start of the 1990s, interest rates were 18%. We got to the COVID, they fell to basically nothing. Now they have risen over 13 rate hikes. You say prices continued to grow. Well, they haven't in Melbourne, and we've certainly seen price growth slow down in Sydney, whereas in Perth, Adelaide, Brisbane, we've still seen phenomenal growth over this period. So I think interest rates can't fall as much as they have in the past, and that has been a massive driver of property price increases. I mentioned before that we're also now seeing way more dual income households than we've ever seen before, and we've seen workforce participation rates reach record high levels, and that's largely because more women have come into the workforce, and that's boosted household incomes. I think we're pretty much tapped out as to how high our employment participation rate can go. So you're not going to get that boost to household incomes that we've seen over the last 20 or 30 years as more people have entered the workforce. The other big one is availability of credit. We've actually made it quite a bit harder to access finance than we used to. If you go back to the 90s and right up to the GFC, it was quite easy to access finance. Now we do have a 3% serviceability buffer. We have seen interest-only caps. We've seen investor living expenses have increased.
Factor in privacy. I'll jump in here just because, I feel like this is probably something I speak to a lot about. Going back to the start of my broking career, they didn't care about living expenses. They didn't care about credit cards. They didn't care about leases. They didn't care about private school fees, private health insurance, strata. You start to layer this all on top, the serviceability, so the assessment rates on top as well. If you've got current loans with repayments, they'll take a buffered on top of that, for example. They weren't around 8 years ago. And that's why I say today, as contrary as it sounds, getting a mortgage is an asset.
Yeah.
It's not a liability. Like being able to be given credit in this country, yes, it sounds ridiculous that it's an asset.
Yep.
But it gives you the ability to go and buy an income producing asset or a home that increases in value, right?
And it does. And I don't think that those kind of limits on availability we're not going to go back to what it was like.
It will never retract. Like you can't imagine credit policy loosening.
No.
Because APRA are watching like a hawk, for example. Banks have to, there's a lot of disclosure around any exceptions they give to policy for a borrower. They look at their back books, and the health on their back books is very much pegged to like their performance in market. So I don't ever think we're going to go back to those days. No. That ship has sailed.
Yeah, so I think that those three things in particular, interest rates basically, yes, they're coming down at the moment, but it's very unlikely they're going to go back up to 18%, which means you're not going to get the borrowing capacity boost you get from it falling. And I think we're going to see a more volatile interest rate cycle going forward, where we do have more periods where interest rates are rising and falling rather than just generally trending lower over that period of time. So we still got the strong population growth, and I don't think that's going to go away. And obviously that does fuel demand for housing, but I don't think we've got as many drivers looking forward as we have had over the last 20, 30 years of price increases. Now, that's not to say prices won't rise, but I think the days of expecting prices to double every 7 or 10 years you're probably now looking more like 15 years for property prices to typically double because of the higher price, but also because accessing credit is harder. Household incomes are not likely to grow as rapidly as they have in the past. And the interest rate cycle isn't working as much in our favor as it has in the past.
Yeah, okay. I appreciate your outlook. Would you consider yourself like a bull? Do you think you're a little bit bullish? Because I'll give some context there. Like I listened to Matt Barry. I'm not sure if you, and I think he's got some incredibly valuable points. I'd love to get him on here and pick his brain, but he talks about it being a Ponzi scheme.
Yeah,
and I'm so intrigued because people buy into that, and now they're cutting their nose to spite their face by not getting into the property market. And that's where I feel it has a little bit of element of danger going. You can cut your nose to spite your face to not get a mortgage or not get into the property market. The only person that's missing out is you.
Yeah. Yeah. No, I don't think I'm overly bullish. I think there's a lot of people out there that are more bullish than I am.
Yeah.
But, I certainly view that, housing in Australia as being very expensive. And I view it as, there's probably, I would love property prices to be a lot lower because then I wouldn't have to pay so much on my mortgage and I could do a lot more. I could go and travel a lot more. I probably wouldn't have to work as hard.
But then doesn't that fit into the wealth effect?
It does.
Prices slow down. And so if you're unfamiliar with what I'm talking about, I mean, you're an economist, you could probably delve into the wealth effect, but that's where we generally feel like a spring in our step. House price growth, and we feel on paper at least, we're doing well.
It does, and 100%. And I think that we have so much of our wealth tied into housing here in Australia. And you talk about bank lending. Yeah. Imagine if property prices fell 30% in Australia, what it would do to the banks. Obviously, what it would do to all of the households. Most of our politicians own investment properties. Because we have so much of our wealth tied into housing, a fall in property prices is going to be detrimental to the politicians' hopes of getting re-elected. So, look, I think I wouldn't describe myself as bullish on the housing market, but I think I'm a realist. I think I can see that prices are going to continue to go up, generally speaking. And as you say, people that say I'm not going to buy because prices are too expensive, well, in 5 or 10 years, they're going to be buying probably, but they're going to be buying at much higher prices than they are today. And that's just the sad situation, I guess. And, as you're a parent, I'm a parent. I do worry, when my kids get to be 25, 30 and looking to buy a property, how much is it going to cost and where are they going to be able to afford to live?
I'm glad you said this because this is pretty much 90% of my conversations with people during the day. I'll go back a step to your point around, hey, you think you're a realist. I love that because, from time to time we'll get like buyer's agents or planners or myself as a broker and people going, hey, mate, you got a vested interest in mortgages or you got a vested interest in property prices increasing because I'm pegged to that.
Yeah.
Or buyer's agents are pegged to that as well. Whereas for you, you have no horse in this race. You're pretty much on the outside of looking on the market. So that's why I respect your opinion there as well. Thank you very much. To your point around kids, and I think we're seeing this right here, right now. I don't know what is it Gen Z or what's like someone that's like mid-20s?
Gen Z.
Gen Z.
Yeah.
So they're probably the ones that, and I know a lot of Gen Zs listen to this, so I hope you're cool with this, but they're going, my parents never had it this hard. Like you're saying, one income, they were able to buy a house, a freestanding house, for example. It didn't take them 13.3 years to save for a 20% deposit, which you don't even need a 20% deposit, so shut that argument down pretty quickly. But there's a lot of this rhetoric, TikTok, Insta, whatever it is, just going, this is, the HEX is killing us, incomes are killing us, we'll never be able to buy a house. I got to tell you now, I deal with a lot of 20-something-year-olds that are buying property, quietly getting on with their life, for example, and just acquiring asset after asset because they're finding ways to move the needle for a yes as opposed to woe is me. Cool. But to your point and ours, which is I get concerned about my kids, you can be worried about this, what's going to happen to my kids, or you could take action and go, I'm going to help my kids. Because I say right now, it would, coming back to the Gen Zs, it's a game of haves and have-nots. You're either property backed or asset backed or you're not. And I don't make these rules. So I'm just playing the game. But I'm buying more property because effectively my kids are going to become the beneficiaries of these decisions that I'm making? Yeah.
Yeah.
How do you have that conversation? Because you're probably far more articulate than I am. How do you have this conversation that you go, if you're worried about it, take some action?
Yeah, I think that's ultimately what you need to do. If you're worried about how much it's going to cost to get your kids into a property in 20 or 30 years, well, buy something now.
Or even for your retirement.
Yeah.
Because I'm probably, and that's probably another cohort of borrowers. Sorry to interrupt you.
No, that's right.
Yeah, probably somewhere in their like late 40s, early 50s. I think even particularly when I have self-employed clients that haven't been paying themselves super.
Yeah.
And I'm like, you're gonna live off fumes when it comes to retirement pension phase, for example. You've still got time in the market to buy a couple of really strong assets that you can then choose to sell off and have a very comfortable retirement. Don't think you've left it too late. So one, put the gas mask on yourself, set yourself up. If you can set yourself up, then you can set your kids up. Yeah.
I think that's important. I mean, I look now, you never know where your kids are going to end up. I live in Brisbane, but I look, and I know investors are not going to Melbourne at the moment, but a 2-bedroom apartment in Melbourne CBD is really, really cheap at the moment. If you think that your kids might, one day want to end up in Melbourne, why would you wait 20 years to try and get them into the market? Buy now while the market's depressed. You're going to get a good rental return on that property now. And potentially, I'm not going to guarantee it, but potentially you'll get some capital growth on that property over the next 20 or 30 years as well. So I do think that people with young kids that do already have properties need to think about, acquiring more of those assets and better assets to help their children in the future. As you say, it's the game you've got to play. It's probably not ideal that in the future a lot of people are going to be relying on their parents to help them get into the housing market. But we're already there. We're already there.
Exactly. Bank of Mum and Dad sits Australia's like 5th or 6th biggest bank.
Yeah.
We're 4 major banks that are most profitable in the world. The Bank of Mum and Dad sitting right behind it. Because of property.
Yeah.
Like that's what lending against assets will do. Guarantor loan, cash outs, for example, reverse mortgages to give their kids some money to get into the market. Yeah, that's the way the game is stacked. And I
also think that it's not actually a new thing. When I first bought my first property, my brother and sister did as well. My parents went guarantor on the loan and they used the equity in their home. And speaking to my dad, his parents did it for him when he bought back in the 70s. I just think it's now obviously not everyone's parents have ever been in a position to do that, but I think it's just spoken about a lot more. People are a lot more forthcoming with that information. But I think for a long time, people have been doing guarantor loans and that. It's just probably a little bit more overt now that it's quite often, handing cash directly to your kids to help them buy a property.
If you lack cash as a parent or equity, I think you could give them confidence.
Yeah.
And I think there's no way to metricate that. But the amount of times I see parents, and I've seen it a lot of times, it's an expensive property market. Oh, this is not the right time to get in. And the kids then taking that energy. If you're concerned about your kids, the last thing you'd be trying to do is talk them out of it. You'd be trying to enable them to get in. If you don't have the means or the financial ability to open doors for them, open their mind.
Yeah.
Open the opportunities, show them what's possible. For example, get into a 1-bedder, get a first home owner's rent, do something because the government's doing 2% loans.
Yeah. And
5% loans, for example.
No LMI. Yeah.
Correct.
Yeah.
It's correct. You've got to frame this up by saying, this is the best it's ever going to get.
Yeah.
Right here, right now, to get into the property market is the best it'll ever get. Lending conditions will continue to tighten as banks, come under more scrutiny.
Yeah.
30, 69-day arrears, whatever they look at, for example, there's got to be markers. Sure, rates will come down, but I feel, I'm going to talk about this, I feel as rates come down, we talk about increased competition, increased borrowing capacity, increased demand is naturally going to push up prices because we're not seeing this supply meet target, let alone meet demand at the moment.
Yeah.
So as you kind of pop the hood on that question, which is supply and demand, what's your analysis, what's your data showing up in terms of what the government should be, could be, and what the market needs from a supply perspective versus what the market's kind of looking at from a demand perspective?
Yeah, I think there's 2 ways to look at supply, right? So there's the supply overall, like how many people do we have and how many new homes do we need to be building? And clearly at the moment, we've got a very strong rate of population growth and we're not building enough new homes to cater for that population growth. But new housing construction is a cycle. And just as higher interest rates slow down price growth in the housing market, higher interest rates make it more difficult to deliver new housing because developers have to pay more for their finance. Margins get trimmed. We've also seen construction costs surge massively over the last couple of years. But also most new housing in Australia is only built when there's people there to buy those properties. We don't have the multi-family or what they call build to rent here in Australia as a big asset class. Most of it's built to sell. And if you're not getting, 40, 50, 60% of it pre-sold, you're not getting your finance to go and construct. So I do expect we're going to start to see, as interest rates come down, more new housing coming out of the ground because it'll actually stack up and there'll be the buyers for that property. I think the other way to look at supply, though, is also what's the amount of stock that's on the market, because you've always got people out there looking to buy in the established market, but at different times you have different levels of supply. And if we look at Sydney and Melbourne, the reason why those markets haven't seen as strong of price growth as we've seen in Brisbane, Adelaide and Perth, for example, is they've actually had a higher volume of stock available for sale. So that gives people that are looking more choice. It means there's less urgency from them to buy in the market at any given time. There's also a sense when you've got this higher level of stock that I don't want to rush in too quickly because something better might come onto the market in the next couple of months. And it might be cheaper, it might be a better location. You go to Brisbane or you go to Adelaide or you go to Perth over the last couple of years, there's been absolutely nothing on the market. And there's been very little stock coming to the market. So this is what's pushed prices higher in those markets, despite the fact that interest rates have gone so much higher, because you've had more people moving into those areas, more people wanting to buy into those markets, and you've had nothing on the market and nothing coming to the market. So when something good comes to the market, there's this huge amount of competition for that property, because you've probably got 30 people that have been hanging out for this property to come to the market, and they're all competing to try and get that property. As interest rates come down, we're going to see more people able to buy. So there's the people at the moment that, their borrowing capacity just doesn't quite stretch far enough to buy where they want to buy. The expectation is from where interest rates were at the start of this year, will fall by about 125 basis points. So that will increase borrowing capacity by about 12.5%. So people that can't quite get into the market now will be able to get in. That will increase demand for housing. You've also got, the federal government now doing 2% deposits. They're doing shared equity schemes with first home buyers. Look, I don't like first home buyer grants. I think there's better ways to help first home buyers than just giving them more and more money. I think it's one of those, we're just kicking the can down the road. It started as a $7,000 grant because of the GST in 2000. It's now 2% deposits, shared equity. Where does it end? Like, where is it going to be in another 15 or 20 years? But again, you've got to play the game. And these schemes are
governments need to be seen to be doing something, right? Who cares what the unintended consequences is? Or are. It's very much, hey, visibility and do something.
Yeah. And that's why they do it. But that's going to drive more demand for housing as well. So you're going to have more first home buyers in the market. You're going to have more people wanting to upgrade that have been putting off upgrading, and they haven't been able to renovate their home because it's hard to get a tradie. They need more space, so they look to upgrade. And you're going to have more investors in the market as well, because as interest rates come down, their borrowing capacity, they're going to be able to use their equity, the yields are going to be better. So, I think it's inevitable that we are going to see prices rise on the back of lower interest rates. And as you said, I think people are getting more aware that when interest rates come down, property prices tend to increase. So I think it's actually going to be more favorable for people that are ready to move sooner, because you're going to get the better opportunities to buy those properties. But you're also going to get the better opportunity to buy at a lower price point, because if you wait 12 or 18 months, yes, interest rates will have fallen, but there's going to be a lot more competition and prices are likely to be higher than they are today.
Yeah. Okay, cool. Thanks very much. What happened with the July supposed rate cut? Because we were sitting there waiting, okay, it's going to be an hour, waiting, and hit refresh. I was like, on hold. And everything looked like it was set for a rate cut. So what happened there?
Yeah, it was quite interesting. I mean, I thought we were going to get an interest rate cut as well, and was a bit surprised. But if you read or you listen to what the Reserve Bank governor said, the tone of that was basically that they've already done 2 interest rate cuts. They don't feel like they need to be in a rush to lower interest rates further, and that they're still worried about the monthly CPI indicator. So they're waiting. It seems like they're waiting for the quarterly data, which comes out later this month. That's a more reliable indicator. They did say that they were worried there was a couple of areas where they thought inflation was stronger than what the monthly indicator indicated. I think we'll get an interest rate cut next month. As long as there's not a surprise inflation figure. I mean, economic growth is still very weak. Yeah. Household spending is still very weak. We're still seeing, the unemployment rate's probably the one shining light, but we have seen a slowdown in growth in the labour market as well. So I do think we're going to get a cut to interest rates, but it was very surprising, especially when you looked at the previous minutes. And the Reserve Bank had considered a 50 basis point cut, which they didn't do. And I think it was a breakdown in communication. They didn't really signal to the market that they weren't going to cut interest rates this month. But I'm fully expecting, she said as much in her press conference, that the direction of interest rates from here is likely downwards. We just weren't quite at that point where we were comfortable cutting yet. And we know from the voting that was actually published for the first time that 3 people actually voted for a cut and 6 people voted against the cut. So there was there's probably always been a bit of a split at the board. We just haven't known about it. But now we do know that there was a bit of a split there.
Yeah, it's interesting, isn't it? I want to go back to a couple of the stats that I've pulled out of your blog, and we'll come back to what you're doing in a minute, Cameron. So over the past 5 years, national dwelling values are up, was it 44%? And over the last decade, they're up nearly 66%. So going back to your point here, and house prices have then risen for the 5th straight month up until June 2025. So you're saying here rates are on the way down. We've had an incredible decade in house price growth, for example, and people are feeling a little bit despondent about trying to get into the market. So sentiment for those trying to get in versus those that are in have seen this rapid acceleration to their dwelling value, home house values. So if you look back on that data and you're piecing together, rates, interest rate data, you're feeding unemployment, you're feeding inflation data, you're feeding migration data, for example, is there a sense for people that are listening to go, hey, and this might smite you, but ignore the data, for example, and get in? Or, hey, what do you need to know to make an educated decision to pull the trigger?
I think the thing you need to know is, firstly, we've talked about it, past performance doesn't necessarily indicate future performance. And we talk about those national figures, right? But Melbourne prices are up 15% over the last 5 years. So Melbourne, for example, has not grown anywhere close to what the national figure has.
Which is like what Perth had beforehand, which is like Hobart had before its boom, for example.
Yeah, well, even now, I think Perth prices are only up over the last decade 3.5%. So they've gone up about 70% over the last 5 years, but they were falling over the previous 5 years to that. So, and Perth's market basically went nowhere for 15 years. Totally. I think when you're looking at all this data, it's good to look at the data, but it's also good to think about, well, what am I doing? Do I want to buy a property and is my intention to try and make a quick buck out of it? Because trying to make a quick buck out of a property is not always the easiest thing to do. But am I going to buy this property? Am I going to hold it for at least 10 years? Am I then going to use the equity that I hopefully have in that property to buy an investment property or upgrade into a nicer area? So I think it's really important for you when you're looking to buy to understand what your intention is and what you're buying that property for. And then it's about, finding the right area that is going to have those capital growth drivers. So you need to look at things like, what's the local economy doing? Is there going to be new housing built in this area, and how will that potentially affect prices? You've got to look at, can I improve this property and can that add value to it? And how much is it going to cost to do that? How difficult will it be to do that? Is there urban renewal going on in this area? Is it going to make it a more desirable place to live? Are there new motorways or transport? Obviously, here in Sydney, the metro is the big thing that's driving property values in a lot of Western Sydney, because those areas now become a lot more accessible and connected to the city. You've also got Western Sydney where the airport's going on. That's going to be a major employment hub. So that will drive values out in those areas, because a lot of people that live in Sydney these days, especially on the outskirts, don't actually need to come into the CBD. They can get a job locally. They live out in these areas, and there's no really good reason for them to come into the city centre. So you've got to think about all of these things. So whilst I think the data is important, it's also thinking about your situation and, carefully studying the property that you're buying and why you're buying it and what your future plans are with that property.
Yeah, thanks very much. I appreciate that. You mentioned about investment strategy.
Yeah.
And I think for people listening, is it cash flow, is it capital growth? And we're saying go a little bit beyond that.
Yeah.
They're markers to invest, but you're saying, hey, give me the strategy. Is this a long-term buy and hold? Is this a trade type of mentality as well? So I guess you've been around investors, or you've spoken to a lot of audiences in the past. What do investors need to know about, hey, this is a long-term buy and hold, and these are the markers that you should be looking at to invest, and here's how to invest successfully as well?
Well, I think the big thing is most of the value in property is driven by land. So if it's a long-term hold strategy, you're probably better going with a house that has a bit of a land component with it. If it's a short-term yield play, well, then generally it's going to be apartments are going to get the better, rental yields on them. So I think for investors, that's the first starting point. Again, I think you need to think about renovations and opportunities to expand on the property as well. And, you think, when I say that, you think just houses, but, some of the older apartments, you can, redesign them and get another bedroom in there, maybe put in an ensuite and add value that way. So I think you definitely need to think about those things as well. But I think the key thing is that it's land value and it's scarcity of product that drives the value of properties higher. And you should always have that in your mindset when you're looking to buy a property, whether it be for your own owner occupation or for investment as well. And I think the other thing to consider is, I think it's worthwhile when you buy a brand new property, especially if it's an older one, doing some renovations to it, because you get those depreciation benefits as well. Some properties are obviously more conducive to that. If you're buying a unit that's only 5 years old, it's going to be much harder to renovate than something that's 20 or 30 years old. So these are all the things you need to think about.
Yeah, cool. Thanks very much. The going around the grounds, you touched on this before around the Perth property market. I want to do a quick around the grounds of the country. Obviously, you take a market like, say, New South Wales, there's so many subsets in that market. You got, regional, metro, you've got houses, units, for example, you got Sydney, down the coast, up the coast. But I guess if you zoom out a little bit and you go performance state by state or around the grounds, how do you see current performance and how do you see future performance as well, potentially? So
the best performing markets at the moment are Western Australia and South Australia. And to be honest, I think that they're going to continue to be two of the best performing markets. And mainly that's because there's very little new supply coming into those markets. WA is still seeing really strong population growth. That's fewer people leaving WA, but more people going to WA as well.
Is that interstate migration or is that overseas migration?
It's both interstate and overseas migration.
I know a lot of people I've spoken to are moving from Queensland or Sydney, for example, Melbourne to a WA. Lifestyle, affordability, for example, work prospects.
Everywhere's close to the beach in Perth. Perth is beautiful. It's just that it's very isolated, and that's I think that's
some people. That's what they love about it.
Yeah, right. Perth people love it. Yeah, they don't like East Coasters over there. But look, and I think it's still got one of the lowest unemployment rates in the country. It's got a very strong economy, obviously very linked to the resources sector. So I think WA is.
That's what I think people have said is it's a one-trick pony.
It is. But I think it's expanding more from just being iron ore and coal. There's a lot of precious minerals, lithium, and things like that. They're looking at mining over there now as well. South Australia. Yes, it's had strong price growth, but it's still actually quite affordable compared to places even like Perth, Brisbane, and Sydney, certainly. You go to Brisbane, I think it's going to be a solid performer, and Queensland, because you're still seeing very strong migration into that state, both from overseas and interstate. Yeah. I am a Queenslander and I go, some of these prices are a bit crazy that people are paying. But
locals in there scratching their head going, what's just happened?
Yeah, but I think if you're trading out of a nice part of Sydney or Melbourne, you can go and move to anywhere in southeast Queensland and probably have no mortgage debt whatsoever.
No mortgage, and you got some cash left over.
Yeah, and you're close to the beach. And I think being a local in Brisbane, I think a lot of those areas that maybe people in Brisbane turn their nose up at, places like Caboolture or Logan City. If you're moving from Western Sydney, you would actually look at that and go, that's great. Like we're 40 minutes to the city, we're 20 minutes to the beach. It ticks the boxes that locals don't necessarily think it does tick the boxes against.
You don't get this deep cold winter as well.
Yeah, exactly. You get the sun. Melbourne, I think obviously from an investor perspective, Melbourne's a bit of a challenge now because they have increased land tax on investors so much.
Which probably isn't the deal breaker when you really zoom out a little bit.
Well, it's tax deductible, and if you're
cost of doing business.
Yeah, and if you're investing in an apartment, for example, then there's not a lot of land tax associated with an apartment or a townhouse because it's more about the unimproved capital value of the land. But I think that economy is still really challenged. I think Melbourne looks really affordable, but I don't think it's going to necessarily see strong price growth over the next 12 months. But I think the next 12 months, that's when that market will really start to pick up. You might have a change of government in there. You might see some of these big projects that they're spending a fortune on maybe being scrapped as well.
And that Melbourne, and this is probably another conversation we have pretty consistently, is zig when others are zagging is the sentiment. Like you said, others are running away from it. That's maybe a chance to go to it. I think you may be early, but you won't be wrong.
No,
is the view at Melbourne,
especially if your plan is to hold for 5 or 10 years. I think you'll do well there.
Yeah.
The Sydney market, obviously, Sydney's always desirable. There's a lot of money in Sydney. There's a lot of people from overseas moving to Sydney. Interest rates are coming down. I think we'll see quite a strong uptick in property prices.
I think it's ripe for upgraders at the moment.
Yeah.
That's probably where I've seen the bulk of the work in Sydney is the upgraders. Yields are still pretty low. I mean, talking about 3.3, maybe 3.5% if you're super lucky. So as an investor, you've got to be able to carry a loss.
Yeah, it's a capital growth play for an investor, not a yield play for an investor. And then we go to some of the smaller markets. I mean, Canberra, I think, pretty similar to Sydney, just moderate, probably more moderate price growth than what we're seeing in Sydney. Hobart's an interesting one. There's a lot of properties on the market in Tasmania at the moment. To me, they look really cheap, a lot of these properties, especially for what you get. But Tasmania is often kind of one of those places that's a little bit lost in time. Time does move slowly there. Nothing really changes that much. Some beautiful properties at really affordable prices there. Some really good rental returns, although your rental returns are nowhere near what they were sort of 4 or 5 years ago before that surge.
Peak,
Look, I think we'll probably see some moderate price growth in Tassie. And then Darwin's a really interesting one because Darwin's been a basket case of a market for 10 years, but you're getting a very low unemployment rate. You've got very good rental returns, and you've got a very tight labour market, and you've got more investment on the gas shelf and things like that. So I think Darwin's one of those markets where we'll probably start seeing a lot of investors going into that market over the next 12 to 18 months because those rental returns. Right. It's a very transient population. So I think about almost 40% of properties are rented up in Darwin because a lot of people aren't from Darwin. They go to Darwin to work, and they may not put down, they might not buy their own property. They might only been there for a short period of time. But I think Darwin is definitely going to be one of the better performing markets this year.
Yeah, right. Which catches a lot of people off guard when you say that, doesn't it?
It does.
Because again, it's like Perth, what it was a long time ago. It did nothing for a long time, and suddenly it's this massissive uptick, and people going, hang on, is this sustainable? And
yeah. But it's also still cheap. I mean, it's the cheapest market in Australia now. So, I mean, the houses are, if you've ever been to Darwin, the houses look a bit weird, and they're certainly a bit different to what you see in most other parts of the country. But, it's stacking up from an investment perspective.
Interesting. Yeah, great. Thanks very much. And what about areas like regionally? So if you go Gold Coast, Sunshine Coast, you maybe look at South Coast, New South Wales, or mid-North Coast.
There's still massive demand for coastal properties anywhere. You look at some of the prices, and they're eye-wateringly high. You go to places like Coffs, and you're getting up towards $1 million for a property in Newcastle's. But I think it just speaks to the fact that people want to live that kind of lifestyle and are prepared to pay for it. And again, if you're exiting a capital city to go to these markets, then you're probably actually quite a ways ahead. Gold Coast, Sunshine Coast have always been more expensive than Brisbane. The fact now, though, that you can have your Sydney or Melbourne job but live on the Gold or Sunny Coast
that's a
and,
big difference.
jump on a plane and go to Sydney or Melbourne for 2 or 3 days a week and then work from home the rest of the time, I think that will continue to drive a lot of demand in that market. There's not a lot of new housing being built on the Gold Coast, so that's contributing to that undersupply. As you move down, the coast of New South Wales, pretty similar story. We know that Byron, for example, has gone absolutely gangbusters over the last few years.
Yeah.
I don't think we'll continue to see prices rise as rapidly as they have, but I think we'll certainly continue to see price growth. Newcastle, a lot of people used to be, if you were in Newcastle, you actually had to go to Sydney and do your job. You don't have to do that anymore. It is becoming a bit of a burgeoning area of itself. Similarly in Wollongong. And I think also the fact that businesses are more accepting of people working remotely now. Further down the South Coast, obviously a beautiful part of Australia, and I think a lot of people would love to own a property there, and you do get a lot of investment coming out of Canberra into that region as well. So I think
it's like that halfway point, Sydney to Canberra. They all holiday on Jervis Bay Way.
Yeah, they probably should have put Canberra at Jervis Bay, right? Instead of in this freezing cold piece of land away from the ocean. And then look, as you move into Victoria, Geelong's a tough market. It's kind of mirroring what we're seeing in Melbourne at the moment. But I do think that this movement towards regional living and lifestyle living, it's probably not going to be as strong as it was during the pandemic, but I think it's a strong thing that people are going to continue to want to move to the coast, move to that slower lifestyle, and I think as there's less job security around as well, people are going to be more inclined to be contracting and doing work remotely, and I think that gives people the opportunity to move to those areas.
Interesting. I think it touches on your point as well around, say, dual income households, and I think it's probably a big part of the conversation that I particularly have, which is you've got dual income households. I'd say strong incomes. Yeah. Right. Take, I don't know, one of my more recent conversations. One partner's on probably 250, the other partner's on about 100, 125. So we're talking about combined incomes 350 and above, right? And there's nothing left at the end of that.
Yeah.
There's no leftover.
No.
And they're going, hang on, if you told me I was going to be on this income 5 years ago, 10 years ago, I would have said, mate, we're set. We're set.
Yeah.
We're going to have some money left over. There'll be an overseas holiday. Kids will be in private school, nice car, and we'll pay off our mortgage pretty quickly. And that was the expectations. And the reality is there's not much. In fact, there's nothing left over. We're going paycheck to paycheck. Yeah. We're not holidaying lavishly.
Yeah.
We don't drive an expensive vehicle. And the kids, we might be lucky to send them to a private school. Yeah. And I don't know, maybe it's this massive shift. Maybe inflation is just that's been on steroids, for example. Lifestyle creep could be a little bit part of that.
Yeah.
Bigger mortgages, so now they're servicing, and they're going, mate, we're burning the candle at both ends. We're both working. We don't seem to be getting ahead. The allure of going to a regional market where one can have a lifestyle, two can have a bit more cash flow as a household, for example, becomes a lot more attractive. And like you said, it's not for everyone because socially it means leaving, flying the nest in your metro location, friends, family, moving to a location purely for affordability. Yeah. It's like you're forced to make that decision as opposed to we would like to make this decision as well.
Well, look, to be honest with you, since I left my job,
which we'll come to in a second.
It's something that my wife and I have considered because my wife's from Canada, so she doesn't have any family here.
Yeah.
And we're like, we could move even say to Hobart and we could sell our house in Brisbane and we could get a very nice house in Hobart. We could probably pocket $500,000 and then there's no mortgage.
And we work because we want to.
We can work. We can be a lot more flexible around work. Now, we haven't got to the point where we're going to do this yet, but it's certainly
scratch the itch.
It's certainly something that we've considered and continue to consider because, there isn't job security working for a big company anymore. Who knows?
Mate, thank you, buddy. I know you don't probably listen to the potty that much, but I say that time and time again. Yeah. Time and time again, if you work for a company, and particularly if you're on a strong income, your income is not secure at all.
No.
You need to translate that to income producing assets. You need to have an additional source of revenue because all your eggs are in one basket.
Yeah.
And that is not good business.
No.
Yeah. But keep going.
No. So I think that more people will think about this. And it's also, childcare fees, and it's all this other stuff that goes along with big city living and having
race.
2 people and being part of the rat race. And it's like, well, what if we only had to work 3 days a week? What if we only had to, do some contracting work for the people that we really wanted to do that work for? And I think, especially the next 5 years, as AI probably replaces quite a lot of jobs, and then there's a transition period between AI replacing jobs and those new jobs not yet being created. I think more and more people will start thinking about this. And it's, do I want to be working 80 hours a week? Do I want, someone else raising my kids in childcare every day? Or do I want to have a slower paced lifestyle? Yes, I'm not in Sydney and I'm not keeping up with the Joneses, but I get to spend more time with my kids. I get to work on projects that I want to. I get to create some different income streams. I get to not have the stress of having a mortgage that's a couple of $1 million, if not even more than that. And I think we'll probably start to see more of that.
Yeah. That to me becomes such a emotional, and it's hard. I don't know, because we've ebbed and flowed in our business, and where we are now is very different to where we were maybe 8 years ago when we started our business. And yeah, it's not that the grass is greener, but these are very emotional decisions. Like you're coming from, you're obviously you're having this, if you were full-time work, nose to the grindstone, you probably wouldn't even come up for air at this point to go, hey, we'd put the handbrake on things and go, but what about our quality of life?
Yeah.
What about the type of dynamic that we want as a family, for example? When you're get up, drop kids off, mortgage, work, sleep, pay your mortgage, repeat. Like when you're on that treadmill, you don't get a chance to actually stop. That's probably when you go for holidays.
Yeah.
On a holiday, like, what are we doing at the moment?
Yeah.
That's probably when the penny drops. You're like, we can't keep working like this.
Yeah.
And that's when I think people probably have their biggest breakthroughs, when they actually have that circuit breaker. Something happens. For some couples, it's a separation. For some couples, it's a health concern. For some couples, or families, it's a child-related issue or family-related issue, and then some it's employment. But you're going, where's this circuit breaker that sometimes people need to wake up to themselves and say, hey, look, is this treadmill of a lifestyle I'm on bringing me closer or bringing me more enjoyment? Yeah. Or can I be doing things slightly different as well? And this might run kind of perpendicular to the conversation we have in property investing, but that's where I probably think you can actually have the best of both worlds. You can build a portfolio that doesn't chain you to a job.
Yep.
You can have income producing assets, because this property, I got to tell you, the Australian economy is built on property.
It is.
I run a business and I don't care. I'll pay my fair share in taxes. I'll be tax effective, for example. But I pay my dues, and that's fair because this is a wonderful country. But when I look at how the deck is stacked in business versus how it's stacked in property, it's heavily stacked in property in this country. Yep. And so you could choose to fight it, or you can choose to get on board and go, right, this is the way the game is played and the economy's tipped this way. I'm gonna go down this path, and I think the Australian economy is, we're a robust economy. So I think for sometimes the faults that we have with property prices, it's a good thing because our country is thriving. Yeah. Whereas a lot of countries, and mate, we're going a little tangent here, but you got to think, mate, we are a blessed country to live in Australia. You look around the world, mate, things that are going on in Middle East, things are going on in Ukraine, for example, China, mate. We've got a quality of life, and unfortunately, a quality of life comes with a cost of living in this country. Yeah. And so, there's a price to be paid when you live in a really strong country that has a strong social system. Not too many people do get left behind as well, pension-wise, NDIS, whatever you call it. So, if you're listening to this and you're like, hey, is this an awakening that you could have, where it's like, hey, do I have a hard conversation with my partner going, hey, do we need to change things? If it just starts that conversation, and it's nothing that makes an overnight decision, but like you guys are just going, hey, pros and cons. Yeah. Hey, could we just rent for 6 months and just see how we go with a new location? Because I think that's what happened with COVID. A lot of people went regionally and gone, now I've got no friends. Yeah. Got no way to make making friends as an adult. Yeah. It's a very different proposition to being a child.
It's all linked to school basically these days.
Isn't it? Your kids the same age? Yeah. Okay, well now we're friends. Yeah. Work-wise, a lifestyle. So I think these are big decisions that you do make. I'm going to fly the nest out of Brizzy down to Hobart. Yeah. In your context, dip your toe in the water and see if it's something that that makes you happier ultimately.
And it's definitely not for everyone, but I think if you actually take the time to sit back and think about what's going on in your life and how you're living. And, you know, the example you said, some couple earning $350,000 and barely scraping by. If you told someone that they were going to be earning $350,000 as a family when they were 20 years old, they would have thought that all their dreams had come true and they'd be fine. But the reality is, as you say, lifestyle creep happens. And
cost of kids.
Yeah. And what if you earned $200,000 as a family, but you didn't have a mortgage and you got to live somewhere else, and maybe you only had to work 4 days a week, or you only had to work 3 days a week. Maybe that's a better outcome. And I think people should probably consider that a bit more than they do.
Yeah, I think if you're taking something out from our chat, I'd say, look, how are you going to run your own race? You know, design your life your way. I've been a big advocate for that. You know, Bernie and I speak openly about the type of life that we want to achieve, and for us, property becomes a really strong foundation, becomes an enabler, then gives you options. You can choose to sell it, pay down some debt. You could choose to keep it, live off the net passive income, for example. Property just gives you options that I think, as opposed to working hard and trying to, you know, for the man or woman, for example, you don't necessarily get those choices sometimes as well, mate. But back to yourself.
Yes.
You mentioned obviously a wonderful career, REA and CoreLogic, and now you've gone out to have Aussie Property Insights.
Yes.
So Substack. So take us through obviously this is a bit of thought leadership piece that you're doing, and you've got your real finger on the pulse. So what can people do to stay in touch with yourself?
So if you're interested, so I do have Aussie Property Insights on Substack. So it's aussiepropertyinsights.substack.com.au, or just Google Aussie Property Insights.
I will include links, but
subscribe there.
None of information on
there. And look, that is going to be a product that I try and commercialize. But basically, for anyone that's interested in property, anyone that's a real estate agent, a property developer, a buyer's agent, a mortgage broker, what I'm trying to do is provide a lot of information. So every week, you know, there's a summary of what happened over the last week, and what it means for the property market. I have regular pieces that I write just about new data that's come out, or things that I've thought about or been thinking about. Not constrained by a corporate saying you can't say this anymore, or you have to say this. And then I've got a product there which I also call Synco, which is Synco. It's an acronym, stats you need knowledge of. And basically for anyone in property, it's all of the economic data that you need to understand. And it's what I view this is people being able to understand the economy better. All that information's in one place, but also if you're working in property, being able to have better conversations with your business and better conversations with your potential customers. So that's what I'm doing. I've also got my own consulting business, which, you know, looking at opportunities to help businesses, you know, with their data and insights, you know, customer presentations, consumer presentations. So reach out to me on LinkedIn or on Twitter or anywhere that I am. But that's what I'm doing at the moment.
I appreciate it, mate. Well done. It's like I said, you sit on a mountain of knowledge. I've heard you speak at a number of industry conferences as well. And I think the way that you can kind of talk to the data in a very easy to understand manner is definitely your strength, mate. So thanks very much for jumping in here and joining us.
Thanks for having me.
I appreciate it. Like I said, if you want to stay in touch with Cameron Kusher, follow what he's doing. We'll include links to Aussie Property Insights and Synco as well. That's where, when I looked at where I pulled a lot of my data from, it was exactly from you, mate. So that's something that I try to keep my finger on the pulse. And I think just aggregate, because there's so much data there, you try to try and curate it and aggregate it. And one central spot certainly helps, mate. So thanks very much. Like I said, this episode might start very rationally from an economics perspective, but move very much into that emotional side. This is a conversation you're going to talk to your partner about, loved one, chosen one, and we're part of that. We've become a conduit, then mission accomplished here at the Australian Property Investment Podcast. That's a wrap, and I'll talk to you next time.